2, 1, and go.
Are investors ruining the housing market? The American housing market has always been a battleground, but of recent, specifically since 2008, investors have taken up a larger share of American housing than all time. We have records since companies like BlackRock, Vanguard, short-term rental moguls, even small-time landlords, maybe even yourself, are buying up more nationwide. Now, some argue that this is adding much-needed rental supply, while others believe they're pricing real American families simply out of the housing market altogether. Today, we're going to walk through the data to know how much of the market do investors really own? And honestly, is their impact going to be felt for years to come? Today, I'm joined by the world's #1 mortgage lender, at least on social media and in my heart, Mr. Scott Bentley. How you doing, friend?
I'm good. I'm going to do my Barron Trump wave.
You're Barron Trump. Listen, we're forbidding all waves that came from any of those rallies just to be safe. Just to be safe,
Fair
we're
enough.
just going to ban all of them.
I got it.
And that will be our only touch on the subject. Scott, how you doing, friend?
I'm good, man. How are you?
Dude, if I was any better, I'd be twins. But we always got something we could complain about. And being on social media, I think that we see an equal amount of people complaining about investors in our housing market. Scott, as a lender, how much are you seeing in, behind the scenes, behind the curtain with investors and corporations buying up properties?
Yeah, and rightfully so. I mean, we see it a ton. We saw it more so a couple years ago, with the rates when they were a little bit lower, just because the higher rates kind of pinched investors' ROIs and what they can make on a property. So it's made it a little bit more difficult to find an investment right now. But that's not to say that it hasn't changed the landscape. You look at what happened in 21 and 22, and all these cash financing programs emerged for home buyers that had negative financial aspects to it in terms of the rate and the cost, but they had to use these programs to try to compete with these cash investors, which is just an additional cost to the borrower. But yeah, it's absolutely had an impact on the landscape. And it speaks to that, that in and of itself, and that program emerging was because of this.
And Scott, would you be referring to things like ninja loans when you're talking about that? 2001, 2002?
No, just like cash programs where essentially it looks like a cash offer, and it's almost like delayed financing. All these different cash programs that emerged over the last couple of years was a result.
Oh, last couple of years. I thought you were still talking about 2001, 2002. Got it. Yeah, we had ninja loans back then that were allowing people to buy. You're talking 2020, 2021, these cash programs. Got it.
Yeah.
Connected.
Yeah.
I was like, man, you went back really, really far, really fast. Heard. So, Scott, starting on our topics, we're going to be hitting 4. A, are investors really buying up all the homes? 2, are private equity firms, especially the big 3, Vanguard, Street Corp, BlackRock, Hi Larry Fink, are they really to blame? Is Trump's latest term and his plan, I say plan because we don't necessarily have a physical one, not because I don't want him to actually fix things. And number 4, if you were to be an investor in this market, is it even a good time? So we want to start with number 1, are investors really owning the market?
Let's do it.
Let's do it. So let's start with the data. How much of the housing market is controlled by investors? Sean has a slide he can bring up showing right now investors own approximately 25% of single-family rental homes as of 2024. This is a sharp rise from 16% in 2018. That is sourced via the U.S. Census Bureau, pretty good one, and CoreLogic, who's a real estate data provider, very good. Investor purchases accounted for 24% of all home sales in 2023, and that is up 17% from 17% in 2019. And specifically, metropolitan areas, Atlanta, Phoenix, Las Vegas, Denver, Colorado, they've seen investor purchases exceed even 30% of all residential homes hitting the market. Definitely a higher number and a higher share when it comes to those multifamily, multiple units, apartment complexes, condo complexes. But it's clear and evident that in metropolitan areas, they want more property. It's clear and evident since 2008, they have bought more property. But it's not BlackRock and Vanguard buying them all. A lot is these mom and pop investors. Scott, are investors to blame here? Are investors driving up prices? What are we seeing with these investors, especially the mom and pops?
Yeah, I personally am seeing a lot less mom and pop investors. Sorry, I'm getting a playback here, but I feel like over the last 2 years, just with the higher rates, I've had so many people that have come to me who want to invest in real estate, but then they look at what the monthly payment translates to with the 20% down at almost an 8% interest rate because the investor rates are higher than the going rate on a primary residence. And it puts you in a position where the payment's so high where you may break even, you may be in the red. And it has a lot of people, over the last 3-4 years, when they were looking at investing, they were in a position where they were in the green. They had an overage in terms of what the rent would be and what their actual mortgage cost is. And that's kind of changed with the rate market. So I think that's specific to mom and pop investors. You look at these conglomerates like BlackRock and Vanguard, majority of the time they're buying with cash. So it doesn't impact them as much. But yeah, it's certainly haven't had an impact.
Now, the mom and pop investors specifically, we're talking about investors that own less than 10 units. And institutional investor, they have two different definitions online. I lean more so on the second number, but it's either 100 or 1,000 units owned to be defined as an institutional investor. And I would say more so the 100 number, honestly, is more so you have more than 100 homes. You do this at an institutional level. So what we're saying is mom and pop are those that own 10 and under. They own a large portion of the properties in America. We'll show on a graph here in a second in topic number 2 about the big boys, that they're slowly becoming maybe less of the market share, but honestly, 20% of all homes we have right now, it's 19.7% of all real estate investment homes being bought are by mom and pops. But you're saying we're seeing a slowdown in that. Do you see that picking up as we move forward?
Yeah, I think if rates come down, we could see a large influx in those buyers coming back into the market just because of affordability and the return that they will make on that.
Now, what about the person listening that's waiting for rates to drop themselves, that's thinking, I'm going to get the opportunity to buy my own home when rates drop? You're saying investors are waiting for the same thing?
I think so. Yeah. I mean, they're definitely waiting, but I think everyone else is too. Like you look at the pent up demand over the last 4 years, there's millions of millennial and Gen Z, that demographic who want to purchase homes who have been completely priced out of the housing market. And the reality is if these rates come down, if Trump is able to get inflation under control, I think the market's going to go absolutely crazy. And we saw it in 21. I mean, there wasn't enough homes to go around. And I think there's even more of a pent up demand now. So it's only going to be worse.
Heard. Also, I just caught you. You were looking at our FaceTime camera. You got to look into people's eyes when you're telling these stats, brother. You're telling facts. The facts of the matter are there are a lot of people that are waiting on the sideline right now. Not just the first time buyer, not just even the investor. Are we going to see a break happen where we see investor rate pick up? If rates were to drop, because we're already at a momentous pace, and we'll show some of these graphs in a moment that show us that investors are buying at a higher click than ever. Will the rate continue up if rates drop? Rate being rate of investor purchase if mortgage rates were to drop. Let me be clear.
Yeah, I personally feel like it would, because it's just I've had clients that have looked at an investment property in the last year who held off because their mortgage payment was going to be $2,700 and they could only rent it out for $2,500. And there's many people that have been in that position where they're thinking about it and it just doesn't make as much financial sense right now. So I think as the rates come down, that's only going to get worse. So that's just my opinion.
I think a lot of people echo your opinion that when money is made cheaper, the investors make more moves. Now, of course, more moves are made available for everybody when rates drop, for personal loans, car loans, mortgage loans. But we know from watching 2020, 2021, beginning parts of 2022, when rates were near all-time lows. I mean, Scott, what was the lowest mortgage rate you wrote between 2020 and the end of 2022? What's the one you think about, like, man, I cannot believe I got that rate?
Yeah, I think it was 2.375% on an FHA loan, which was just absolutely crazy. And it's practically free money.
Practically free money at that rate. We're talking pretty much free money, with today being a stark difference. 6%, 7%, like you said, for some investors, 8% on home prices that are in an all-time high. So Scott, if investors are only buying up so much now, and we know they're going to buy up more later if rates were to drop, what should an investor even be, should I say, what should a first-time home buyer even be doing to prepare themselves for when rates drop so that they don't get beat out by an investor?
Yeah, that's something I've been yelling from the rooftops. You have to be prepared. I think you've got to have your ducks in a row from a financial standpoint, understand your qualification, your budget, what those specifics look like, but you also need to stay on top of inflation and these jobs reports, because if you're not staying on top of the market and rates do start to trickle down, I don't think it's going to happen fast. It's probably going to be a 6 to 12 to 18 month reduction. It's not going to happen overnight. But as that happens and unfolds, you want to be ahead of the curve, because if you're on month 12 or 18 and everyone and their brothers now jumping in the market, the home prices are unfortunately going to go up. And that's the reality of where we're at and where inventory is. There's just not enough homes to support the amount of buyers that will be in the market if that happens.
Completely agree. Let's move on to topic number 2. And before we completely move on, we will hit more on what can be done to get inflation down when we hit on Trump and his oncoming administration, what they plan to do for our economy. But first, we have to talk about, is private equity up to all of this? Is private equity what's actually causing our current housing market crisis? Let me start by showing you this graph. Can we bring this slide up, Sean? We already have it up. Let's scoot over to the actual graph. We'll show this table in a moment. The graph we have here, though, I think it's not backwards, is it? It's not backwards, is it? No, we're good to go. We're good to go. Yeah, there we go. This graph shows the amount of demand that has picked up in the investor space since 2008. The gray and the dark gray are pretty much our normal everyday investors. I would consider dark gray to be the career investor, not quite an institutional investor, as they own 10 to 99 units. Light gray is 10 to 1 units. And then when we get into these blues, we're now seeing institutional, or what I would define as institutional investors. In the big scheme of things, institutional investors are buying less than 2% of all of the homes in America. But Scott, we see on this graph the same thing, that it continues to go up, and it continues to go up over time, seemingly in a flow with affordability. When it becomes affordable for the first-time buyer, it becomes affordable for everybody else, and the investors seem to be jumping right on the bandwagon right at the right times. So Scott, again, I'm going to ask the same question. If rates drop, are we going to see investors stockpile the housing market and cause another 2020?
I think there's a very good chance, yes.
Not a lot of people like that answer, Scott. Dive in on that for me.
Yeah. I mean, I think the reality is, and we just touched on this, there's just not enough inventory to go around. There's a shortage of 4 to 5 million homes nationwide. And this is a result of the 2008 housing market crash. And there was just a lack of building after that time frame. And there unfortunately hasn't been an uptick in building since 2020. Nope. We're in a position where inventory has somewhat grown a little bit, but that's because of the higher interest rates. And we're in a position where affordability has just gone by the wayside. And unfortunately, majority of families can't afford a house. So that's why we're seeing homes sit on the market for longer, is the rates and the environment. And as the rates come down, there's just not going to be enough inventory to support the demand. And there just hasn't been enough building since 2020 to make up the deficit. And I think it's going to take a long time to really dig into that. So,
and I'm pulling up some stats to verify what you're saying. In November, America had 953,000 homes on the market. For some perspective,
November of last year?
November of 2024. And to give some perspective, in 2008 pre-crash, we had well over 4.1 million homes on the market. And pre-COVID, about 1.6 to 1.8 million is where we'd float. So we're significantly below the line. And as of December, the number actually dropped. We dropped back below into the 800,000s. Now, seasonality-wise, this is pretty common for us to see a lack of inventory in December and January, and then it slowly upticks in February. But it's still not a welcome sign to see us scoot farther away from the 7-digit mark in a market where we need homes. Now, when homes hit the market, let's be clear, not every single home is being bought by an institutional investor. But Scott, can I tell you, in doing some research for this episode, I got overly curious about not just are these big three, being BlackRock, Vanguard, Street Corp, not only, and you can go to the table if you want, Sean, real fast, not only are they buying properties, not as big of a pace as many people would believe, but I started to look into the companies that insure the houses. I started to look into the companies that do financing for the houses. I started to look into the companies that build the houses. And Scott, I looked up the top 5 in gross revenue for pretty much every category, from property management to lending to building. Every single one, 20 to 30% is owned publicly by the big three, Vanguard, BlackRock, and State Street. And I know they're a boogeyman, BlackRock is, but they're an obvious one. And on the screen right now, we have the top 11 builders. It might only be showing 10 that are in America right now building homes. 20 to 30% of each and every one of them owned by the big three, funding these giganto funds that are then recycling back into investing in the actual assets of our country. And that's where they get labeled as more of a scapegoat, in my opinion, when mom and pop are definitely buying more. But when you see these numbers, Scott, what's your initial thought? What's your initial feeling?
It's scary. It's certainly scary that they have their hands in every pot. Not only are they controlling the market when it comes to the investments and pushing up home prices and what that's doing, but then you also look at all the services surrounding the housing market and how they have their hands in every pot. It's scary, I think.
And it's a rabbit hole that we've explored and could explore deeper, but leaving it at face value, it's a gigantic index fund with an enormous amount of financial influence, well over $11 trillion of assets throughout their holdings, and a lot of government influence. They were tapped on the shoulder in 2008 and tapped on the shoulder in 2020 to financially assist our very country. So to say they shouldn't have involvement in the buying up of real estate, or the involvement of our insuring of it, or involvement of our building of it, seems like a fair thing to state, but at this point they own so much that their removal from the market might topple it all together. So now we're kind of in this catch-22. And it's a catch-22 that I think many people see that don't frankly have a lot of solutions for it, but ultimately it does keep these companies moving. Ultimately, they are publicly traded companies, so the ability to buy up as much as you'd like, up to, I think it's 20%, and then you have majority share, is possible. Frankly, I share a similar sentiment with you. It's a scary thing, because you get into monopoly, you get into antitrust laws, you get into lack of competition, lack of quality across the board when you have a vested interest from the same parties across the board in a given sector. And housing, food, there's a lot of sectors that they have their hands pretty heavily in.
It's so true. Yeah, and it just speaks to the current trend and what our society is looking at in terms of our country, like speaking more towards an oligarchy than a democracy, because you've got all these big players that control everything, that push on these politicians to pass laws. I mean, TikTok in and of itself is a perfect example of that. It's scary.
What part of TikTok?
Just how, Facebook lobbied millions of dollars to try to get rid of TikTok, and paying off these politicians to try to sway these lawmakers to pass this TikTok ban. I mean, that's
the dot that gets connected for a lot of people is the money that's going to politicians and where it's being sourced from. And some people making those ties to some of these big funds and wondering, is there a intermingling going on that's causing a lot of the unaffordability people are feeling? And is it all at the expense of us for the betterment of pockets in the form of real estate investing? And you can look at a lot of numbers and you can see that there is a large amount of private equity in real estate. But the fact of the matter is, they're not the ones buying all the real estate, is I think where we can basically come to an end on the private equity side. What would you say to that, Scott?
Yeah, it's not as significant as what people think. It's the mom and pops. They've got more of the percentage there.
Yeah, they got hands in a large portion of other real estate facing items that doesn't require them to own as much, but I mean they definitely are buying 4.4% in metropolitan areas like Las Vegas, 4.6 in areas like Atlanta. So they are buying up properties in certain areas and causing a flux. Will that come to more markets in 2025? We don't know. What we do know is we have a new president for the next 4 years who has stated many times, and if you're curious about it specifically, we are tracking it with our Trump tracker, making housing affordable again. Scott, you and I have been hitting on this huge on TikTok, on Instagram, on Facebook, letting people know what's actually happening. And I'll let you go deeper on it, but there's been a lot of promises. There's been, for many people, a lack of written out plans, but a lot of words around making housing affordable again, and driving down mortgage rates, slashing regulatory costs. What are your thoughts as we walk into this term that is promising making housing in America affordable again?
You know, I would love to say that there's one specific thing that I could hang my hat on and say, this is likely to fix the issue, but unfortunately, I don't think that there is. And this is something that I'm picking apart as we speak. You know, there's no context to these plans. There's no step-by-step process. I mean, Trump has mentioned he's going to increase drilling, but then we have other aspects of his economic agenda that are inflationary, like the tariffs and, you know, cutting corporate taxes and some of these things, you know, and the trickle-down effect. And it's one of those things where there's not enough context right now. And I hope that in the coming days and weeks, we get more of that from the Trump administration, because I'm very curious to see how exactly he plans to get inflation down amidst all of these agenda items.
You mentioned oil. It was a number you brought up that if oil were to, basically the connection is oil to power, and power is one of the largest inflated items on our CPI report, which is the monthly report our Federal Reserve gives the status of the housing market, or I'm sorry, status of our economy. Shelter is on there. But power, if it were to actually come down in price, if it were to deflate, if drilling would cause that, it's only 6 to 8% of the overarching problem of inflation. It wouldn't affect 92% of the problem. And more than 6 to 8% of the problem is shelter. Many people cite this as the core problem to all of it. If somebody can't afford to get the American dream started, how are they supposed to live and grow and have goals and be a great citizen for this country if the American dream isn't even on the goal sheet because it's not attainable? He's spoken on this quite a bit, even recently coming out and stating he wants to slash mortgage rates. As a lender, what's your reaction when you see somebody get up there and say, I want mortgage rates to get as low as 4, even under 3%, I think it was?
Yeah, it's concerning. I think that it's going to do more.
It's concerning. So wait, you as a mortgage lender, you hear 3% rates. I would think you hear, okay, buyer demand is going to go up, affordability is going to go up. I can serve those clients. Why do you not like it?
True. Yeah. I think as someone who's been established in the mortgage industry, for me, it's not all about dollar signs. It's about the general public and being able to help clients. And I think right now in the last 4 years has been one of the most frustrating times for me in my career, because the primary demo that I've helped over my 13 years in business is the first-time home buyers who have been absolutely crushed by this. So to give you a little bit of context about why I think that way is there's just not enough inventory. And as these rates come down, if we do not have additional inventory, it's just going to cause a situation like 2021 again, but I think it's going to be even worse just because of the pent up demand over the last 4 years. And everyone's going to feel like this is their shot. But, you know, I know Trump, he's mentioned these freedom cities, which you and I have discussed at length, but this is not something that's going to be an immediate fix. I think this is going to take a decade, maybe a decade and a half to really come to fruition. And it's just not going to solve things overnight. So if he does reduce rates in the next 1 to 2 years, it's going to be a bloodbath. I mean, you have so many homeowners like you and I have discussed who will be so much more well equipped in this market because they have $200,000, $300,000, $400,000 in assets and the equity that they have in the home that they've owned that's appreciated. So it's just going to, I think it's going to be a slippery slope, and it's going to impact the first-time home buyers the most, which at the end of the day, like I bought my first home at 23 and now it's out of reach for them. The average first-time home buyer is 38 now. It's sad.
I had my first ever inverted TikTok post, inverted engagement. I sent you a picture of it. where
I saw it.
Yeah, it was the first post I'd ever made where there were more comments than there were likes. And I forget how many views, I don't know how many views it has, but you can go look it up where I asked, for the homeowners out there, could you requalify for your home today? If you had to rebuy it at today's rates, today's price point, could you afford it? When I say, it wasn't even, I thought it was going to be close. I thought it was going to be like 60-40. I wouldn't be able to do it. It was like 98-2. 98% stating I would not even close. And the answers, you know, people online like to flex a little bit. They don't like to look as weak. I mean, the people of self-deprivating themselves, like, I couldn't afford this home if they cut it in half and doubled my pay. You know, I couldn't afford this if there were 4 of me. Like, it just, how far they would be from being able to live or buy the same home they just got 3-4 years ago. They just refied 2-3 years ago. It doesn't seem healthy, A. And B, doesn't give me any different a view than you have of first-time home buyers are getting screwed in all this. Investors are still buying, and when they're not, they're just waiting and stacking cash to get ready to buy. And then the people who are retiring and relocating, I'll speak Delaware specifically. You know the amount of people that are coming down from the Northeast, Connecticut, New York, New Hampshire, Maine, Vermont? All these people that are moving in from New Jersey? Because they can,
Jersey's outrageous.
Yeah, because you could pay $12,000 in property taxes in Jersey. When I tell people the property tax for them in Delaware is $1,600, they said a month. That's fine. No, it's a year. Even better.
Yeah.
It's
and there's not enough inventory in Jersey too. That market is just so
you hit the nail on the head. This is basic economics. We need more supply. Where do we get it from in Trump's term? Where could he strategically, if you were in the White House, you're brought on as the mortgage representative of the country, and you're here for first-time homebuyers. You're there with Scott Turner at the Housing and Urban Development Division, and now you get your say. What would you do to help make a brighter world for the first-time buyer in these next 4 years?
We need more starter homes. We need regulatory cuts for these builders to be able to build these $250,000 to $300,000, properties, and just it's missing right now. You look at the average price point on these new builds, it's $450,000 to $500,000 plus, and these first-time home buyers can't afford that. And so we need more starter homes. And I think he's headed down the path. Like he's mentioned, cutting regulatory costs. He's doing things, but I think if we don't solve the fact that investors are going to come in and scarf up these properties, the fact that you've got all these other homeowners that are sitting on 3% rates with all this equity who will be more well-equipped buyers in this market. If we don't solve the inventory issue, the first-time home buyer demo is just going to be crushed even further, unfortunately. So I think we need communities where it's $250,000 to $300,000 properties where investors can't come in. This is strictly for shelter, for people who are buying a primary residence. I don't know how you track that because obviously they have to sign an intent, at closing, an affidavit stating they're going to live there for 12 months. But after 12 months, they could rent it. So who's tracking that? How are we going to?
And who's showing up to the house on month 8 to make sure they haven't already rented it out? Is it you?
Exactly. Yeah. Right.
There's no mortgage police that I'm aware of.
No. Well, there is. I've heard there are auditors that will go to properties where.
Don't go do that and say these guys on YouTube said no one's going to catch them. We're not saying that at all. I've just never heard of them, and I'm sure there are people who think similarly.
Yeah. No, it exists. It's just not as widespread as you would think.
Now, to back up a couple stats that you had said, you mentioned inventory earlier. Yes, we have 80,000 less moving into the new year than we had in December. Than we had in November. Also looking at regulatory costs, the National Association of Home Builders did a study, PhD in economics, stating that a $394,000 home had $96,000 in excess of regulatory costs. That breaks down into 12 different costs that vary from pre-build to getting the foundation begun. The foundation from the physical build is the most expensive part. So we need to build smaller homes. That's one of the holdbacks to why, regulatory costs and foundation. And the last piece you brought up about being able to build starter homes, there is some discussion about the lack of verticality in so many markets that everybody is building out, everyone is building horizontal, and there are ways for condos, apartments, even townhome units, row home units to spread in these areas, and if they could only be purchased by those looking to buy and not those looking to invest. Again, how do you monitor that? Will the policymakers come in and make that so? Canada's done it. It works. Other countries have done it. It seems to work. Will the next 4 years bring that? We'll see. Let's move on to the last point. Is now even a good time to invest? We've hit on this a little bit, but is now a good time even to start investing for those considering jumping into the game? The biggest question is now the right time, or is the market headed for a slowdown in 2025? Scott, what say you?
I think that if rates come down, it could be a good time to invest. Sorry, my chest just cramped up on me here.
Don't be falling out on me right here live on TikTok.
I need a banana. No, I think if these rates come down, it would be a good time to invest as an investor. But I think right now where we are, the landscape with rates at almost 8% for investors and rents trajecting down right now. You know, I don't know if you've looked at the rental graph and what rent prices are doing right now. But
it
they're actually
has started to go down, which is very interesting. And maybe we hit on this, but I'd like to tie this little knot in your head, and maybe we hit on it again another week. But for the first time, we've seen market median home price detether slightly from rental median. In the last 8 years, as price goes up, rent's gone up. Now we're starting to see a slight detethering. Is that from investors being a little bit more kind? Is that from a shift? Is that from renters finally not renting? We'll dive into that more. But again, you see, as rates coming down, more opportunity for investors. What specific investor are you talking to there? Are you talking to the multifamily guy? Are you talking to the person wanting to get started? Or are we talking to maybe someone that wants to get into house hacking? Where's going to be the best opportunity, you think, in 2025?
I mean, I would say all of the above. House hacking can be a little difficult right now. You know, I think duplexes and triplexes are so hard to come by. There are some out there, but it's even more limited in terms of inventory and options. But I think it applies to everybody. You know, the first-time home buyer who's looking to house hack, I think it presents more of an opportunity in terms of a financial gain and being able to put yourself in a better financial position because the rates are less and it's cheaper to borrow money. But then you've got the flip side of that, you know, and how this is going to impact those that are in that first-time home buyer bracket that want to house hack because they have less in assets, they've got less leverage. So I think it applies to everybody, but I think there's certain parts of that group that just it's unfortunately not very possible for.
Yeah, and to the investor out there, and I can hear you through the screen that's saying, I'm waiting for home prices to come down. I'm waiting for the crash to begin investing. I'm waiting for 2008 to get my foreclosure. Can I paint you what happened in 2008? In 2008, do you know who bought up $130 billion worth of toxic mortgage assets? BlackRock. That's just one of the big three. That's not talking about JP Morgan. That's not talking about Bank of America liquidating the foreclosure assets they have. That's not talking about these gigantic firms that bought up properties like candy from the families that were having foreclosures while the banks were getting bailouts. There was a lot going on that was not good for the standard everyday mom and pop American. So,
and what was interesting, sorry to cut you off.
Please cut me off. I talk too much.
Was passed on to borrowers.
Yes.
You look at the increase in FHA mortgage insurance after 2008.
Yes.
The upfront premium and the monthly premium went to 1.35%. I remember originating loans like it was the mortgage insurance on a $250,000 loan was almost $300 a month. It was insane.
Yep.
And they used that for 4 to 6, 7 years to make back what they lost.
Absolutely.
To give it back to BlackRock, and it was just passed on to the consumer. So it's they lean on these people to bail us out, but then the cost and the negative side is passed back to us, which is frustrating.
Yeah, well, we know that Obama walked in with his administration with a tall task, and they did pass bipartisan-wise a bill that strickened lending, especially lending in mortgages. They made it so the credit score was more dependent. They made DTI stricter. I mean, before 2008, there were things that existed called ninja loans. People talk about adjustable rates all the time, like ARMs, but ninja loans, no income, no job required. Are you kidding me? It was a wild world. And so it needed some more legalities. It needed some more regulation. Some argue it was too much regulation. And I believe in today's day and age, we're now starting to see some of the regulation, some of the legislation is actually constraining the demand that could come from first-time buyers in a market like today. And some would argue that a crash is needed. What do you think in the terms of a crash is needed? Because if this continues for another 4 years with seemingly no shift in prices or prices even going up, is somebody watching this that's 20, 25, 30 that hasn't gotten in the real estate yet, are they up a creek without a paddle, or can they prepare?
You know, as much as I would love to say the market's going to crash, the data unfortunately just doesn't support it right now. You
What
look
data
at,
specifically? What are you looking at? Are you looking specifically just supply
yeah,
and demand?
foreclosures, people who are in delinquency. It's actually down. It's way down compared to what it was in 2008. And it's just a different market. Like it doesn't speak to the position we were in 08. And I think a lot of people aren't looking at that. And as much as I would hope that it would fall out, because I would love to buy more real estate, I would love for my clients for it to be more affordable again. But I just don't foresee that happening until inventory has a massive spike, because it's simple supply and demand. There's just not enough homes to go around.
Yeah. And the not enough homes part, we can't hit enough. And the reason that matters is if we have 10 people, all with pre-approvals, ready to buy 2 homes, well, both of those homes are going to get a lot more attention unless it was the opposite. If it were the opposite, where there were 10 homes and 2 people, price points go down.
And we're still seeing it right now. I have buyers that are submitting offers here in the state of Maryland that are up against 3, 4, 6 offers. And that's in an environment where affordability has been crushed. Could you imagine when they come down to 3% and everyone can afford it again?
January
20,
had something
30,
in the sauce, man.
40?
January had something in the sauce. I'm telling you right now. And we'll have the graphs to know it by May to know if we're right. But man, it seems like the people for the last 6 months, 12 months, 24 months have been sitting and waiting for the opportunity to strike. They're now seeing that opportunity is never going to be coming with a big neon light. And so a lot are just saying, you know what? I don't like it, but I'm going to do it anyway. And a lot of people, myself included, see this as an issue. If people start waking up and saying, you know what, I'm just going to take it on, it doesn't matter. There's the argument of unaffordability ringing its ugly head in 3 to 4 years, but then there's your argument of it keeps supply low and it keeps prices moving up. For homeowners and investors, it sounds good. For those that don't own real estate, it sounds like a nightmare.
Yeah, I agree 100%. I don't know where it's headed, and I hope that Trump can build enough homes to solve this deficit. But
and I agree. I do not wave any flag of either color, but I do want affordable housing. I do want people to be able to afford the American lifestyle, the American dream. We can't tout a country that's the land of opportunity when the opportunity to obtain the American dream is unattainable.
Yeah, literally
doesn't
the
make
staple
sense.
that our country was founded on, you know?
Yeah. And now between foreign and domestic investors, the American dream is being siphoned out from under us. So as we continue to analyze these things week after week, we will monitor Trump's campaign. We will monitor vacancy, affordability, investor opportunity, all of the like in real estate. So follow if you want weekly updates on everything that has to do with the housing market, with everything that has to do with the mortgage market, and keeping up to date with current events in housing. Myself and Scott are going to be talking housing every week, and stay tuned for the location of our next episode because it won't be here. Check in the description to get